We've got Robert Simon, who's a Managing Director and Global Portfolio Trading Head for the Asia Pacific region at Citibank. He joins us on the show from Hong Kong. Robert, to begin with, tell us what your broad buy or sell calls across asset classes are right now.
We're still relatively bullish on agriculture, on precious metals, the U.S. dollar, equities. We like emerging over developed, but we have seen a lot of that price action already flow through the system. On the things that we would be more cautious on, energy, any of growth, construction-related stocks, the metals, the miners, we would be a little bit more cautious on.
Robert, although the Indian markets do seem to be seeing quite a bit of volatility off late, there has been a strong run-up since the month of January. So what do you make of the rally that we've seen in emerging markets, as well as the moves that we've seen for the rupee against the greenback?
Emerging and currencies have done very well this year. January, February, we saw 17–18% performance in emerging, and that really is along the trajectory of what we expected for 2012. What our call was up 25%. The risk now is that you've realized 3/4 of that upside potential in the first 2 months of the year. We have seen a pullback in the last 3 days, but we think that is healthy. We still feel that we have potentially another 3%, 5% to go on the downside, but we feel that the upside targets now are much more reduced, where it is in that 10 to possibly 12% upside range from here.
And Robert, what kind of risk-adjusted returns are you expecting from equity markets in 2012, and also specifically from emerging market equities, what are you expecting?
We feel our original targets for global developed were up 20%. For global emerging was up 25%. Once again, we have seen some positive growth for both of those, some very strong returns in January and February. Global developed is up 11–12%. Global emerging is up roughly 17–18%. And even with the pullback in the last couple of days, we feel that there still is upside. We feel that that's probably more in the 8–10% range for developed and the 10–12% range for emerging. So still positive on it. We think that the next 4 to 8 weeks we will have a period of consolidation, but we feel that investors in general are looking to quote unquote buy those dips and get more fully invested when the opportunities present themselves.
Okay, so Robert, you're saying that the emerging markets may gain 10 to 12% this year alone, but specifically for India and China within the emerging markets, how would you profile them?
At the beginning of the year, China really was our pick of the BRICS, and Russia really was the number 4 of the 4 countries. China, we feel, it has been a relatively underperformer for the year. We still think that there is a very good upside there. We like the growth targets coming out of China, the 7.5%, and the comments of building and further developing the domestic market are very encouraging to us in a muted inflationary environment. For India, we feel that it's come a long way. The 22% positive returns that we've seen, our year-end target at the beginning of the year for Sensex was 18,400, and that's within 6% of where we are now. So that remains a little bit challenging. We still feel that there's some political uncertainty there. We feel that from an inflationary environment that there are some challenges. We feel that it has still some room to move up from here, but we feel that it's come a long way so far, and we would look for some consolidation within the next month.
Right. And lastly, Robert, what's the outlook on risk in as far as the U.S. recovery and the EU debt crisis goes? Do you believe that risk is receding, and do you think the markets have factored that reduction in the recent rally?
Yeah, there's been a lot of strength globally in equity markets, and I think that there are exposures out there that could definitely derail this. Iraq with the oil picture, if there are spikes in the upside above $110, $120 a barrel, could seriously slow global growth. If Greece, for some reason, doesn't continue to go in the fashion that the world is pricing in right now, the U.S. elections, there are a lot of ifs out there. There are a lot of challenges out there. Right now, what's being priced in isn't a Goldilocks environment, but it is the glass is half full. And if any of those shocks actually do come through, we definitely could see some pressure on the downside. That said, I think we'll probably have, if things continue to move along the way that global investors are looking, we'll continue to have some consolidation in the next few weeks, and hopefully end of the year 10 to 12% above where we are now.